Mai, thanks for doing this again. I appreciate
pleasure.
it. Yeah. So last time you were on, I've gotten feedback from people that they like your finance knowledge.
Really?
Yes.
Oh, okay.
So thanks for coming on and sharing again. And we're talking before the podcast about, well, a lot of things, but how important it is for people to have like knowledge on finance, because there's things like interest rates when it comes to your savings account. And we're talking about inflation and how a lot of people get duped and think that, hey, you know what, let me just put my money in a savings account and we'll just keep it there nice and safe. But the downside to that is inflation. Talk to me a little bit about like what we were talking about earlier about inflation.
Yeah, so, I'm sure a lot of people have heard like the word inflation, but maybe they might not really fully understand the impact of inflation. Think of inflation as like your cost of living, right? Cost of living, things that you pay for consumer goods, your eggs, your milk, gas prices. I think inflation would impact a lot of people, especially those that have a fixed income. Like think of your grandparents or people that retired, they have a pension. Assuming that's their only income, Social Security, they're on a fixed income. But if you're on a fixed income and your cost of living is increased every year, inflation, your dollar isn't going to be worth as much.
Right.
So the idea behind inflation is, just how the prices are just going up, and your dollar or cash in your account
is losing value.
Conservatively. You are conservatively saving money in a savings account.
Yes.
You do see it. There's no fluctuation because it's like FDIC insured. It's safe. But you're still losing money conservatively. You just don't see it.
Yeah, absolutely. So if, your bank account is earning interest at, say, 1% or something along those lines.
Well, it's not even 1% right now.
What is it?
So before COVID, and I started banking in May of 2008, which was pretty much like the last recession we had because of mortgage crisis and housing bubble. And interest rate at that time was like 0 point something. And the year before COVID, which is 2019, we started seeing interest rate rise maybe like a year or 2, 3 years before that. Like interest rate was like 0%, and then we saw it like 0.5%, and then 1%, and then it got as high as 2.5% on some high interest savings or CD accounts. There are still people that buy CDs. I don't know about right now, but after COVID, interest rate has dropped dramatically. So savings accounts, like in a traditional bank right now, you're probably going to see 0.01.
Yeah, so super low.
And that's annual percentage yield. That's not on a monthly. It's annually. So it's an annualized return. So it's pretty much 0%.
Wow. And then we talked about inflation. Last time I checked, inflation was a long time ago, but probably about like 3%. Does that sound about right?
I think it's a little bit less than 3%, but I think it's like, it depends what you're buying.
Okay.
So I was telling you about like my current situation. I'm looking at properties, and I was talking to a realtor, and we were just talking about like cost of materials, cost of labor, because properties in her market, needs to fix up the property, do renovations. Her husband's a contractor, so she was explaining like the challenges that they have right now. And due to COVID, a lot of manufacturings were closed, right? Like businesses were closed.
Of
Our
course.
local market was like restaurants, they were closed for a little bit, and now things are opening back up. They're not fully at full capacity or their usual revenue like before COVID, but manufacturing, like the just material for renovations, right? To remodel your home. She was telling me that the cost of those things have been going up significantly because the demand and supply. A lot of people are renovating their homes because they're living at home more, or just because they just want to fix up for investment reasons. but costs for those materials and labor have been going up because demand, and not only that, the supply has been impacted because the manufacturers, their company has to shut down for quite some time, which impacts their
Right.
inventory production.
Right.
So, we would see, it depends what you're buying, but you might see the cost of lunch or cost of whatever that you typically purchase would go up.
We were talking about that earlier when you're going out to lunch, and even I went out to dinner last night, and the prices were increased. For those who live in the Los Angeles area, I went out to a place called Luggage Room, which is in Pasadena. They serve pizza, and for a pizza maybe pre-COVID was about $14-15, and now it was like $18.
Yeah.
So like, $3, we're talking about a $3 price difference isn't like gonna break the bank, but still, like, if that price were to increase like every year, $3, $3, by the time 2030 comes around, you're paying like $50 for a pizza or something like that. So that's a ridiculous inflation, according to the certain like current situation. But I've heard in other countries of like hyperinflation where I guess you could look this up in Investopedia for the definition or whatever, but the inflation was just going crazy high, 10%, 15%, something along those lines. And it's not good. So kind of bringing this back to why inflation is important. If you're saving your cash and not investing, like we're talking about, in a vehicle that is earning 8% or 10% or 20% or whatever it is, then you're losing out because of inflation is at a higher rate than current interest rates on a savings account.
Yeah. And then, the pizza example that you provided, that's one thing of many things that we purchase on a daily basis or a monthly basis, and it adds up.
Yeah.
Yeah.
Absolutely. So in order to combat inflation, talk a little bit, I guess, just generally, not giving advice in specific. You were telling me a little bit about ETFs, which stands for exchange traded funds. I was looking at my portfolio today, and it was doing fine. We were talking about that a little bit a while ago, last year or whenever it was. But to have investments in different financial vehicles is important, and ETFs, exchange traded funds, is one of them. How did you learn about ETFs?
So I think the unique circumstance that I have is I work in banking. So I am exposed to a lot of financial information, and through work experience, I'm able to gain knowledge. So right now, as I'm on the podcast, full disclosure, I do not represent any firms. Information on here is just for education, or not educational, I would say entertainment reasons,
Okay.
and everybody's circumstances, financial circumstances is unique to themselves. And, when it's investing, it really is like everybody's decision to invest is really unique to their situation.
Yeah.
So like age, matters, because I was just talking about that earlier too. Like if you look at somebody's age, it's not to disqualify them, it's because risk tolerance. If you really pay attention to the older group versus the younger group, typically when you talk to like the group that is entering retirement age or is retired, typically, not always, they tend to have a more of a conservative approach to their money.
Less risky.
Because they don't have the time to recoup the loss if there are any.
Yeah.
Versus somebody that is like 18, 20, and at that age, 18, 20, you might still live at home. You might not have a lot of expenses, responsibility, like kids to worry about, mortgages to worry about, and you have this huge time horizon, like 30, 40, 50 years to recoup that if you take risk and it doesn't work out and you have a loss, you have time to recoup that loss.
Yeah.
But somebody's older, or whatever their career cycle is at the time, if they're a young professional versus like mid-career or retirement stage, it's very different for age, right? And then it's also the person's the reason why I said age is not always conservative. It's the person's risk tolerance preference. You can be like 80 years old and they're still stock investors. Stocks is like the most riskiest thing because you're buying into one company.
Right.
That's why people say like, the term have all your eggs in one basket. That's where you invest in like one thing and you have all your eggs in one basket.
Right.
So there's a variety of different investment vehicles that you can invest in. I think it really depends on the person's risk tolerance.
Absolutely.
Yeah.
And I think diversification is extremely important. I don't think you ever want to have all of your eggs in one basket. It's just, for me, this is my own personal risk tolerance.
Yeah.
I'm pretty much, I would say when it comes to my investments, I am like conservative, like right in the middle, a little bit more risk than conservative, just a little bit. But I heard
like
this.
Moderate.
I'm moderate. I'm like moderate plus.
Yeah.
Yeah. If that makes sense. But I heard this rule of thumb that sounds pretty logical, that your age should be the percentage of safe investments that you have. So
I know what you're talking about.
I'm 32, going to be 33.
Yep.
So I should have probably about 33 of my investments in safe, conservative, risk adverse investments. And then the other 70% or whatever risky, which makes sense, because what you were talking about for an older person who's say 75 or something like that, you should have probably 75% of your assets in something that is safe, so that if the market drops, then you don't lose a ton of money and you can keep your finances where they're at. What do you think about that?
That is a actual thing. So it's not always accurate, but that's a good starting point. It's the 100 rule. So you take 100 and you minus your current age. And that gives you an idea of where that person is. And then you work backwards based off their answers, or preference, to determine should you increase more conservative or increase more aggressive model for their portfolio. So for example, what you just said, like if somebody is 30 years old and you take 100 minus 30, then 70% should be, a little bit more moderate to aggressive, maybe. It depends. And 30%, or actually, I'm sorry, 100 minus 30. So somebody that's 30 years old, 70 should be more aggressive, moderate. Is that what I said? And then 30 should be cash, conservative, or, something that is not too risky, just to balance the portfolio. That's a good starting point to look at it. Yeah, a good way to, just like, somebody that's 80 years old, maybe like they can still take some risk, 20%, but 80% should be more conservative. So it's not like it's a right answer for everybody with a 100% rule,
Right.
but it's a good starting point to kind of see like where you should be, and then you work backwards based off your own personal risk tolerance.
Gotcha. So the people that are viewing this are ages about 25 to 35 is my males as my audience. Like what types of investments are there out there for people who are, age 25 to 35? This is a similar age that we're in right here.
Well, yeah, I guess.
Yeah.
Yes, 20 something, yes.
Yeah. So I don't know what type of investments are out there, say, that are like risky. We were talking about stocks earlier. We're talking about ETFs. I know that you can't give specifics, but explain for people who don't know, like what is a stock? What is it?
So, when it comes to investments, there's actually essentially maybe a handful of things. Like stocks would be investing in a portion of the company. So, when you buy a stock, you're buying in a share of the company. And some companies, some stocks, they're considered growth stocks. There's value stocks, stocks that pay dividend. So there's a variety of different stocks. But when you buy a stock, you're buying in a share of the company, a percentage of the company, and you have voting rights. Yeah, so that is the most risky type of investments. But every investment has its own pros and cons. Like for example, like one of my favorite investment would be real estate, specifically residential. But there are also risks associated with it, even though I think that there are more pros to it than cons for myself. But the reason why I'm bringing it up is when you buy a stock, during the trading session of the day, business day, the price goes up, price goes down, right? But you can sell at any time. It's liquid. You can get out of it, yeah, at a loss or a profit. But when you buy a stock, you see the price goes up and down, but you haven't sold it yet. That's called unrealized gain or loss. It's unrealized because you haven't sold it. It's just the price going up and down.
Right.
It's only realized when you actually sell the stock.
Gotcha.
But it's also like, the risk of losing your principal, but how liquid is that money?
Yeah.
For example, if you invested in a stock, you're like, oh, I need the money to pay for whatever it is. Yeah, if you sell it, it could dip a lot and you might lose some money, but it's liquid. You can just place an order, it gets executed, you get some money back, right? Or it can go the other way, you made some money, right?
Yeah.
But with real estate, it's considered more illiquid, meaning you can't really get your money tomorrow.
Right.
Because you have to list the place, find a buyer.
Right.
If you find a buyer, it takes maybe 30 days for that person to close with a traditional loan. So it's, as you can see, like some investments are more liquid. So that's something to consider as an investor, and or illiquid, because those are things to consider, like going in and out.
Absolutely.
Yeah. Stocks is just one form of securities. There are ETFs, mutual funds. There is a difference. They're similar, but there are differences. So ETFs are also, the similarities would be ETFs and mutual funds. They are a collection of stocks. So instead of buying one share of something, like for example, if you buy one share of Tesla, even after their stock split last year, it's still trading like under 800 right now. To buy one stock of Tesla, it's like you have to come up with a $800, for one.
For one stock.
Yeah, for example. But if you buy an ETF or a mutual fund, the fund would potentially have a small percentage invested in Tesla, Spotify, Starbucks, or whatever the fund objective is. So every time you invest in a mutual fund or an ETF, when you research the fund, there's usually an objective to the fund. They will tell you our objective is for growth. And growth means that they are trying to like appreciate the money that you put in. Some mutual funds will have income and a little bit of growth. When you see income, that means that they may be buying bonds that produce like, interest, or they have they invest in stocks that produce dividends. Think of dividends as interest. Like if you buy, I don't know, like Bank of America stock or whatever, Wells Fargo also, they would pay you like dividends every quarter. So not only that you can get some appreciation from the stock, hopefully, they're still giving you a quarterly dividend, kind of like extra incentive for owning that stock. So when you're looking to mutual funds or ETFs, the fund objective will explain to you what their objective is. And it also will tell you what kind of sectors they're investing in,
Right.
like technology or financial or fintech, which is both. There's so many sectors out there.
Yeah.
Yeah. So when you do those research, ETFs and mutual funds, those are the things that they will tell you, and it even tells you like what they're currently investing in, like the stocks that are currently in the fund,
Right.
percentage of that, and then it breaks down like percentage of maybe multiple sectors in the fund. So those are things to look for. But the difference between ETF and a mutual fund is ETF trade like stocks. Mutual funds don't. So if you buy an ETF and it's during the trading session for the day, you'll be able to see the price change throughout the day, just like a stock. The difference with a mutual fund is they trade NAV, net asset value. So you don't know how much the cost will be when you buy into a mutual fund until the end of closing day.
I see.
You don't see the price change throughout the day like stocks.
Interesting.
So, and it goes for selling a mutual fund. You don't know what the total cost that you're going to sell it for until end of the day.
Right.
Yeah.
Just as a general principle, kind of taking it like way back to the basics, the general principle for any type of investment is buy low and sell high, correct? So you want to buy low, say if you had bought Tesla 8 years ago or something like that, and you look at the price of the stock, say it was, I don't know, $100, or say it was $100 and now it's trading at $800 or whatever. That difference is about $700 if you were to sell the stock today. So that's kind of the basics, the basic principles of investments, even with houses or
business,
anything is buy low, sell high. And then talking about stocks compared to mutual funds or ETFs, we're talking about diversification. We're talking about not putting all of your eggs into one basket. I think that's very important. I think any investor would tell you that. Do not put all your eggs in one basket. So the difference between putting all your money on Tesla compared to putting it in a mutual fund or an ETF that has some Tesla, that has some Apple, that has some, I don't know, Salesforce, or has a diversification of businesses, stocks, I think is a pretty important topic to talk about.
And it goes back to like the person's risk tolerance, right? Like there are people that want to take more risk. So they'll say like, oh, a mutual fund or an ETF is not giving me the return that excites them. You know, like if they trade, day traders, they usually like buy in really high risk penny stocks. Penny stocks is typically anything less than actually $5. That's considered a penny stock, even though it's not a penny. But they like that risk. They like that excitement because you could make a lot of money day trading. But is it for everyone? No, like it's not. You have to really have time to do that. Be able to have like, the financial to take the risk. Timing, like we work 9 to 5 most of the time. But it goes back to like the risk tolerance, trading stocks. You might be able to see a better return if you pick the right stock.
Yeah.
Right? Like you can make so much money. Like if you bought Tesla years ago at $100, even if you only bought Tesla and you put all in 10,000, for example, you would have made a lot of money right now because it has, like it's just a ridiculous return. But if you bought an ETF, you might not see the return like buying like a stock like Tesla, but are you okay with that? Like it may generate a 5% return, 15% return. It may not be like a crazy return as Tesla, but you're not taking on a huge risk.
Right.
But Tesla is like a good example of like, oh yeah, I could have, should have, would have. But there are a lot of stocks that people put money in and they might not see the return that they would like to see in a certain period of time. But I think that when people invest in anything, they should invest for the long term. And it goes for real estate, it goes for even stocks, because taxes matter. For example, if you were to trade, and like day traders, they pay a really high tax because it's short-term capital gain. There's long-term capital gain taxes. So on the difference of what they purchase, the cost basis for their stock versus how much their realized capital gain is, that difference is what they pay taxes on. And if it's held for a year or more, I think a year and 1 day, then that capital gain becomes a long-term capital gain, which is a better tax rate.
I see.
Yeah, and that goes for real estate too. But that's just one of the many reasons of doing things long term. When you look at the historical return of the S&P 500 in the last 20 something years, yeah, there's some years that have like a really big dip and some years that have really good returns. But when you hold on and you see the average return, it's probably making like 8% or so average return. But if you are in it for a short period of time and at the wrong time, you can't really time the market. Like look at
Right.
2019, like we were doing pretty well, and then unexpected things happen like COVID. Like that's something that we can't time or expect to happen. Like, so if you are investing short term without the long term mentality, you could have been investing in the wrong time, and you're pulling out too soon because it's for short term. You're buying a house with that money. Like, it's not really a smart decision depending on your goals with the money.
Right.
Like if somebody were to say, I'm going to invest my money into a property within 6 months to a year, maybe that money that you're going to invest in a property for a down payment should not be invested in the stock market, because you don't have enough time horizon to recoup that loss. If the market corrects, you lose your down payment.
Yeah.
So those are things to consider, like when you're investing. Going back to the mutual fund and ETF. Mutual funds is a little bit more, I would say, complicated than ETFs. I like ETFs because they trade like stocks. You can get in and out. Some of the ETF have active management fees that are a little bit higher than like the passive ETFs. But with mutual funds, there's A shares, B shares, C shares when you're buying in. And it's a little bit more complicated and more fees associated with that than stocks, because nowadays with like trading platforms like Robinhood, I'm sure like Fidelity, Wells Fargo, or just like Scottrade, Ameritrade, whatever, they typically have free tradings nowadays. So when you buy and sell a stock, there's no fees. But with mutual funds, there are fees associated depending on what type of fund or shares you purchase. Like A shares, for example, just to keep it really easy and simple. If you are a long-term investor, then the A shares might make sense. The difference with A share and C shares, for example, it's usually A and C's. B's is not really there, but it's usually A and C's that you typically would run into. A shares, you would have to pay an upfront fee. Usually it's kind of like a more expensive upfront fee, but in the long run, when you purchase more mutual fund shares, their fees are significantly less. So ultimately, your overall fee structure would make more sense with A shares, even though you're paying an upfront fee because of the discounts that you would get after that. C shares, you don't pay anything upfront, but if you do sell it within a period of time, they charge you a fee. So those are for long term or for short term people. Like,
Okay.
yeah, they may not want to invest that long, but within a certain amount of time, enough where they could keep the mutual funds and not sell and still be okay. So it really depends. If people are looking to mutual funds, those are things to consider.
Gotcha.
But ETF, for me personally, I like ETFs more because it works kind of like a mutual fund. Some are actively.
So C shares are. Is there a difference between A shares and C shares besides the cost? The cost of them? Is there like A shares are like a higher class of, or like more technology based compared to C
No,
shares?
this is just strictly
Okay.
on the cost to get into those mutual funds.
Okay.
Yeah.
Interesting.
Yeah. That's why some people that like invest in the market, they would say like it depends on the investor mentality. Like if you feel like the overall market performs better than a fund manager, which is like a fund manager would be a advisor that would oversee the mutual fund.
Yeah.
They pick and choose their stocks for the fund, and people invest in the fund. Those are fund managers. But there's some people that I've met, and they have they think that the overall market can outperform the fund managers. So if you think that way and you believe that, then you can. I'm like squirrel. If you think that, then maybe like investing in an index fund. Like an index is like S&P 500, the top 500 companies in the U.S.
Yeah.
Yeah.
Yeah, that's important. I guess we'll start to close. Index funds, we're talking about the average return on the S&P over however many years. If you're not a person who is like dialed into stocks and different vehicles like that, and you kind of want to like a set it and forget it, I feel like an indexed fund is probably the way to go, because you're not taking a huge amount of risk when you're investing in the S&P 500, because it is so diversified, right? It's 500 companies in the US or what have you.
500 biggest companies that are publicly traded on the exchange.
Yeah. So considering my audience is about 25 to 35, in general, what's some advice that you would like give to a person that is wanting to invest in something?
The one thing that I would recommend for sure is just to self-educate yourself. Like just learn and understand like how a stock works. Like just even like if you want to start trading stocks, then open a brokerage account, like look at how placing an order looks like how it looks like. You put a market order, limit order, what does that mean? Just research it, and what's a bond, what's a ETF, what's an annuity, what's a life insurance. Like just learn the foundation first. Don't jump into something that you don't understand. So I think it's just like, when you learn something new, like driving a car, like the first thing is just learning first, and then you can choose whatever car that fits your needs. Like it could be a stick shift, it could be this, it could be a Tesla that's electric, but the first is the foundation. Like just understand what risk and benefits each investment can give you, know the pros and cons, the worst thing that can happen, before you get into it. And there's so many books out there, so many things that you can Google online, just to learn about these things. But the first thing is just educate first, and then you invest in those things.
Gotcha.
Yeah. And I would suggest that the younger you are, what I would tell my younger self is I wish I started sooner, even though I think I started pretty young. But the earlier you start, the better, because as you get older, it only shorten your time horizon to take risks. So the younger you are able to take risks. But if you're able to self-educate yourself, learn about real estate, business, stock market, how the economy works, inflation, and all these things, it's just a collection of information, and using your critical thinking to kind of tie it all in. Like, how do they relate to each other? Like, like if the 10-year treasury moves this direction, how does it impact interest rates? If the Federal Reserve says they're tightening the credit, what does that mean? It's not just like taking the information, but be able to like understand the moving components of the financial system. And so when you are able to educate yourself on what's going on, then you can make your best informed decision. Take risks, but they're calculated risks, because you did your due diligence, you educate yourself, and you already know the worst things that can happen and plan for it. So if you are getting into like a investment like real estate, you're like, okay, this is the worst thing that can happen. If this doesn't work out, then I will turn and do it like this. So knowing your risk and planning for those risks that potentially could happen and forecast it. Like if I invest in this company, the forecasting of this company is like, for example, it's COVID, and I personally think that technology is the future and it's not going to go anywhere. The way that people live and businesses, the way they operate, it's going to be very different. But what businesses can you forecast? Can you predict in this environment that we're living in will still thrive and be able to sustain and have that will survive through COVID? Like Amazon, like I'm not saying buy Amazon, but I'm saying like think about Amazon. People are buying it like online. It's easy. They have great customer service, and they make it so easy, fast shipping. You can find anything on there. So business models like that, like, are you investing in something that is quick money, like just get in quick for GameStop? It's not really a sustainable way to invest for short term, or a business model that doesn't make sense. But you have to project, like, will this be a company that will have year over year increase in revenue, and why? You have to ask yourself why. So there's a lot of things to consider and look into before making your investment decision. So those are my quick advice.
Gotcha. Very cool. Thank you so much, Mai.
Yeah.
I really appreciate it. My Pham, ladies and gentlemen.
Thank you.